Now, related to CCJ, David says, check the Black-Scholes prices. Check the Black-Scholes prices on Monday. Okay, well, let's just see what the Black-Scholes prices are. We talked initially about this position with a midpoint of 94. It had a bid, of course, of the 48 cents and an ask higher. Now, if I'm going to check any specifics on the individual option in my bull put credit spread, I know with the stock at 86.18, this 77 strike put has a probability above 85% or more. We saw it in the 87% range. But now that I'm analyzing the profit and loss chart, looking at my what-if scenarios, pros and cons, outcomes, and so forth, I want to click this more information button here, name the trade details. I'm going to rule research, and we are going to go to options research. This gives us all of the information, including the historical chart of the option since it's been released on the market. The default is the option bid price compared to implied volatility. And you can change that multiple ways. I can look at the option last price versus implied volatility, percent if assigned, not assigned for the covered call traders, Black-Scholes value, stock price, option volume, option bid, ask, open interest, time value, delta as well. So let's just do, we can see the true number, David, for the Black-Scholes as well as other pricing models down below, but we're just going to do the chart here real quick. And it's not too far off. The option bid price here is at 116, but the Black-Scholes is at 83. So even 66 cents that I mentioned, if when I entered the order to sell that 77 strike put on Chemico for 94 cents, they dropped the ask price down to 94, and so the midpoint would have been around 66 cents or so. The Black-Scholes has it as 83. But let's take a look at some other numbers. So we scroll down further. We have our graph here. We just look at that true historical graph. By the way, for those of you interested in historical charting on options and things of that nature, this chart here for every option that you're researching, analyzing, can pull up on the option chain, it's available on all levels of subscription. You don't need the historical level of service to see the pricing charts of the option versus the stock or the option versus implied volatility, anything along those lines. That's here on every level of service for any option you're researching. It doesn't count as part of the historical. Okay? The historical offers much more. If you want to delve deep into history, back testing search results, back testing individual stocks, seeing options, historical chains as well, that's all there on the historical services. But this view here, if you want to compare the graph of the pricing chart of the option against implied volatility, against delta, against the stock price, it's there for you on all levels of subscription. Now down below, you've got a vast variety. Again, here's our bid and ask spread over here, 48 cents for the bid price of the option, ask price of 140. Current, excuse me, last price was 72 cents, so much higher than midpoint, but that was right at 4 o'clock. They got a price fill at 72. Now, was that a buy or a sell? I'm not sure. I'm assuming it's a sell. But it's a pretty good price, 72 cents. If we got, again, the other 34 cents or whatever it was for the long option, we're getting still a good 40-cent net credit on that 2-point spread, David, if it got filled. Last session close was 113. Volume, open interest. This area here, the first sections, in the center section of the research tool are related mostly to, sorry about that, keeps going further than I thought. This is related to covered calls. And we had this discussion a couple weeks ago that even investors who tell me that my trading goal, my trading plan, what I trade is iron condors. What I trade is I buy calls and puts. I do a lot of calendar call spreads. And the brokers see this too. And the brokers, you probably receive it. You receive a little survey at the end of the year or sometimes every 6 months, but they also are tracking what people are trading in their accounts. We do too, based on access. Who accesses what strategy? How many times is the search tool accessed in strategy A, strategy B, strategy C? How many positions are in the portfolio for strategy A, strategy B, and strategy C? The reason why this whole middle section, 50% of this whole middle section, is basically set No, right here. There's the cutoff here. Basically set for returns for covered call trading. Because covered calls are still technically the most popular option strategy. Even if you're using options to trade spread trades, iron condors, zero DTE, testing out all these other things, you've got your calendar call spreads, poor man's covered calls that you like to use. Somewhere in a portfolio, whether it's an older IRA, shares of stock you've had like Ernie, who has HPQ, because he worked for Hewlett Packard for years and years, and Agilent, and I think his cost basis on those shares of stock is maybe $3. Who knows? But, he trades covered calls, out of the money covered calls against those accounts, against those shares, excuse me. So even though he's trading more married puts now as new positions, he's trading his weekly picks of the day covered calls and naked puts and long calls. He takes a look at some of my bull put credit spreads from time to time. We've got VIX calls and we've got other things that we do in our portfolios also. He's still trading covered calls in some way, in some aspect. So what they found is that most people are using covered calls, even on shares of stock they've owned for years and years and years and years. That's why that's there. And then, of course, if you're doing a naked call or a naked put, you've got that here. But now we get back into the time value section. Over here on the right, you've got those more elaborate values, the probability, theoretical probability above. The implied volatility of the midpoint is 0.62, not too high, not as high as I thought. The implied volatility versus stock volatility ratio showing us that it's overvalued. The implied volatility of this particular option compared to the in the money and out of the money options over the next sort of 4 weeks, 5 weeks, or 6 weeks. That's the SIV, the stock's implied volatility index based on an average. Current implied volatility range at 100%. And then you can see that here. The total range is 0.3450 to 0.625. Black-Scholes SIV. That's closer to our number, David, isn't it? That's closer to the bid point, is 47. Now, the Black-Scholes SIV, what is that? Is the Black-Scholes ratio, but using the stock's implied volatility value, which is lower, it appears, than the actual implied volatility of the option. Well, no, we're seeing it as a 1.3. A Black-Scholes SIV is 0.47. And then you've got your delta, gamma, theta, vega, and rho. But down here, further below, there's that 66, 68 cents we were talking about. The 20-day Black-Scholes ratio is 66. The 50-day Black-Scholes ratio is only 29. And the 100-day Black-Scholes ratio is 0.33. So we've got some, as we saw on the graph, we've got some increased implied volatility on this option recently. The Barone equation, 66 cents for the 20-day, pretty close. 29 cents, pretty close. These are actually looking pretty even for Black-Scholes ratio versus the Barone model for that. Now the Cox-Ross is way off base. I don't want to say way off base, but it is very, very low. Cox-Ross has it only at 4 cents, 4 cents, and 4 cents. I'm gonna take a look at that and talk with the programmers because I think this is errant. This doesn't look right to me numerically, with Black-Scholes and Barone being pretty close on all levels. Some discrepancy here at the 50-day, which you'd expect. Very little discrepancy at the 100-day. That's okay. Very little discrepancy at the 215. That makes sense as it gets smoothed as we move further out in time. This just doesn't look right for the Cox-Ross equation. I think there's some value that's off as we're calculating it in the background. Now again, we saw that the implied volatility of the current option is at 0.6241, and that's at the midpoint price. And we know we're at 100% right now at the midpoint price. The total implied volatility range since this option was released on the market is 0.3450 to 0.6250. And down here, what this grid is showing us is what was your expected implied volatility if the option was at 48 cents, if it was at the natural bid, would only be implied volatility of 0.50. Our range that we set at midpoint, if I place that order again to sell to open this 77 put on Cameco. Oh, I'm sorry, it's not Cameco, is it? It's CCJ. But on CCJ, this would infer an implied volatility of 0.56. what we're seeing is right about here, that current implied volatility of 0.625, 0.63, 94 cents, so it's a little bit higher. And at the ask price, it'd be an implied volatility, an inferred implied volatility of 0.73. And then you have, of course, your current implied volatility range and the lifetime implied volatility range as well. All right. So that's just some of the detailed research that you can get to. And as we saw, okay, the Black-Scholes and Barone has us right at about that 68 cents that I said I'd expect, David. Where if I put in my order to sell to open our October 77 put on Cameco, CCJ, but I'd immediately probably see the ask price drop to 94 cents from 140. The bid would stay the same. So the midpoint would go to about 0.68. But let's say we got 0.66 and we did get 36 cents for this particular, the bought option, the 75 strike, the lower strike. We're still in our wheelhouse that we want, 17.6%, not the 30% that we were seeing on the search. I'm sorry. When did that change? What did I change and why did that change? CCJ dropped out. Let's go back to the default search here. Maybe there was an extra run that just came through. That's a possibility too if the bid-ask spreads changed, but I don't think they did. There we go. All right. Okay, no, the Oclo is still in there at the 30.7. That's the one we probably should have used, but we used that Cameco one. Oh, Cameco was after I took out the bid-ask. I'm sorry, folks. That's when I took this out. That's when Cameco appeared. There it is. There she is. So it's not going to be a 42.9% return. But as you mentioned, checking the Black-Scholes, doing our further research analysis, knowing that with a bid of ask, of 140 and a bid of 48, that if I put in that initial 94 cents, I'd see things adjust. Maybe I get 66, maybe I get 68. I'm still where I want to be with that theoretical probability of the stock remaining above 77. But that's how you can do it. That's how you can look at the further research analysis on the individual ones. Different views, of course, of the pricing models, expectations of what would the volatility be inferred if I did get filled at 66 or 68 cents in that range between the bid and the ask, and what would the current IV range be if I did get filled at 68 cents. We'd only be at 26. It's probably on the lower range. But compare against the pricing models, David, they're right there. And you can toggle between the different historical views of the options price versus the implied volatility and much, much more.